it's International Women's Day on Sunday. We're
Yeah.
recording this on the Friday. There's been talk for as long as I can remember in the financial services industry about a lack of women in proportion to men being invested and preparing themselves financially for the long term. And I'd like to, with your experience, why is this? And then what are we seeing around International Women's Day from financial services publications, writers, and then the companies themselves? What are they doing to empower women, if anything?
Well, it's a good question, Kez. I think March 8th is very good. It's a nice hook to hang, this issue on. But obviously, women investing is a 365 day a year kind of issue. But if we look at some of the recent stats, I think even some came out this week. I don't think I'm misquoting Boring Money. I think they've just come up with some recent stats that say there are 11 million male investors in this country, about 7.4 million female. So it's quite a big mismatch there. If you look at the most recent from FCA, that's obviously the financial regulators' own Financial Lives survey, most recent one, I think they came out with a figure of about 1.5 times as many males invest as females. I think if you go and dig into HMRC stats, you'll find that there are 1 million more female investors with cash ISAs, cash individual savings accounts, than there are male. So there is this what's become known as a gender investment gap. And I think we have to believe those figures. I think possibly some of those figures could be a little bit clouded, because are you actually saying this is are you taking a kind of households into consideration here? So if you've got man and wife, male and female partners with paying off a mortgage using some kind of investment fund, do they both count as investors, or are they both on the line for the mortgage? But let's assume that it's about 1.5 times as many male investors than women. There are some obvious reasons, and these get cited a lot. Female lack of knowledge, fear of investment loss, choice paralysis is something that comes up. There is so much choice. Where do I blooming well start? And I think these are they're well realised sort of challenges and obstructions. I also think, and we are talking in 2026, I appreciate that, but I think there are some quite ingrained reasons as well over and above this that go back decades. And I think it's certainly the case in the 50s. I'm not sure if it was in the 60s, but in that kind of time frame, women had to go, if they wanted a loan from the bank, they had to go to the bank and get some kind of confirmatory signature from their father or a male representative to get a loan. Now, that's 60, 70 years ago, and that might say, what's that got to do with investing today? But, I think there are some of these long ingrained kind of situations and experiences still kind of percolate through the system. Women, the whole, we know that times are changing, but there would naturally probably be more caution amongst women. They have children, they tend to stay at home. It's not the only situation, but it tended to be the case. So there are these reasons why these kind of gaps exist, and actually we know that other research surveys show that women are better investors than men, actually. So and so there are kind of today's issues, there are some longer standing issues, and we might also extend this to, well, okay, we're talking women investing, but actually the whole investing education piece has been around as long as I can remember. I mean, no one's really kind of cracked how to make the financial education thing totally palatable for all male and females alike. But sticking with women in investing, I thought it would be quite interesting actually to see, well, okay, we're bound to see in this weekend's personal finance press, and I have already seen stuff come over my desk already, where companies have, used International Women's Day as a hook to hang a story or a piece of research that they've done. Okay, that's fine. That's timely for them. That's extra clicks for them this weekend. But I thought it might be interesting to look at the wider sector and see what kind of information there was out there from the financial service industry firms about women in investing generally. So I did a little route around, and I thought I was going to be met with this absolute wall of information, sections on websites marked women and investing across the piece. And in fact, that wasn't the case at all. I found relatively little stuff. One or two of the banks have gone out on a limb with kind of women and investing sections, educational sections on their websites. A few of the wealth management firms, as you might expect, one or two do a similar thing. The fund platforms, again, they make an effort. So they're trying to kind of do a more educational thing that's all year round rather than just hanging on one date. But it's quite interesting, because when you then drill down into that content and look at what these firms are writing, actually some of the stuff is quite generic and would apply as equally as well to men as it would to female would-be investors. So the amount of actual kind of female orientated stuff is quite small, I think. And whether that's, whether there are wider issues about this going back 2 or 3 years, maybe the whole, gender debate thing is an issue that companies don't want to touch. So they don't want to kind of be seen to be heading off down the women in investing route only. I don't know. But just from my experience of having a look around at what was there, there were one or two kind of quite, bright spots, but not as much stuff as I thought there would be at the start of the process.
And a story that is always dragged out around this time of year is how much more men have in their pension pot on average as women. The figures that tend to be aligned, something like a woman will end up with about half the pension pot as a man. Now, obviously, there's some lessons in kind of compound interest and taking gaps out of why this could be the case, which is not, I think you and I will probably both agree, these are not particularly complex things to get around, but they just need tailoring in such a way to speak to women so that when you're taking leave from work and you're not going to be putting those contributions in, what that actually means for your end pot. Do you think this is a case of we're just not doing a good enough job of tailoring the information that's out there? Or do you think it is a much wider systemic issue where we're just not as engaged into investing for the long term as we should be?
Yeah, well, probably a bit of all of the above, probably, Kaz. I mean, I think a report came out this week, I think, of Scottish Widows, the big life insurance firm, do a retirement survey every year, quite a sort of, it's an annual piece of research work. And I think they discovered that in terms of a gender pension gap, male retirement pension pots average come in at £19,000 a year, female 13,000 a year, and that must be to do with career breaks and stuff like that. So it's quite a stark difference. At the same time, we as I say, we go back to this point where there's a lot, we're discovering, I think research also shows that younger cohorts of women are investing now, and these things have these findings obviously take time to unwind. So hopefully as time goes on, these gaps or these imbalances will level up to a certain extent. There's no real reason why they shouldn't. But then, if it goes back to kind of, is it down to policymakers and companies to kind of help nudge people a bit more? We've got this kind of targeted campaign thing coming up in the springtime quite soon, where banks and similar providers will be able to, nudge their customers a little bit more down the investing route without giving them specific personalized advice. Will this make a difference? How innovative will some of the messaging and communication be? Will it have the desired effect and get people thinking about things? But we have been here before, and so maybe it does seems to be these. And obviously, the Chancellor at the moment, Rachel Reeves, wants to get the whole nation investing more in, certainly in UK firms. So there's plenty of kind of willingness, but how it's executed has always seemed to be a much bigger issue. And there's a certain amount of preaching to the converted. Well, that's fine, they're already doing it. People that know. But what about, I was reading somewhere, we're heading up to, in terms of all monies in ISAs in the UK, we're heading up to the £1 trillion mark. But 3/4 of that is in cash ISAs. So there's an enormous, groundswell, for want of a better word, or a rump of money that could potentially, some of that money could, I think, be diverted towards investing in the markets, for example, a bit more. That kind of figure does just seem tilted the wrong way, especially given that if we're investing for the long term, and if people aren't investing in equities or within the markets, then potentially their wealth profile can be damaged by keeping too much money in cash. And it's that kind of, that simple message of this, in the financial press, we're always banging on about inflation being the terrible eroder of wealth and all this and that, but it clearly maybe does, and that investing is in other sorts of assets is one way of keeping ahead of inflation a little bit and keeping your returns real. But maybe it just needs, that message needs to be rammed home even more. And I'm very hopeful when we see this little red squirrel as part of the UK retail investing campaign in his bathers, when we see that full campaign come out through the course of this year. We're not only, squirrels, I have to say, a squirrel kind of is famous for burying his nuts, isn't he? Right? But does burying your nuts really equate to making money on the markets? Because having a little safe, having a little war chest of nuts, like they do in my compost heap, is one thing. And it's kind of we've been there and done that with furry animals. I remember when National Provident Institution, a once pretty good life office that went, on the skids, used to have a red squirrel as its logo. We used to have, I think it was Save and Prosper, used to have little honeybees, for people of a certain age. So that's fine, but clearly the message hasn't got home because the figures suggest they aren't.
And you alluded to earlier on how not that long ago in the grand scheme of history that women did have to attend a local bank branch with their father, their husband, to get a loan out. There's obviously been a massive societal shift of equalization, which I think we can all agree is a positive move, but there still seems to be a bit of a gender gap when it comes to just regular banking. You've written about this recently. What have you seen, and where have those gaps presented themselves?
Oh, well, as I say, I did a kind of a ferret round of the high street providers, the big name investment firms, in terms of women in investing. And I thought I would be absolutely overwhelmed with stuff, and there wasn't. I mean, to name check a couple of high street banks that did have stuff on their websites. Lloyd's did, Santander did. I mean, in fairness to Santander, they have a women in investing section on their website, and some of the content therein is then very much geared around, aimed at women and women, the issues, confronted by women. A lot of the educational stuff I've seen elsewhere has been more generic and more, so I'd say it could equally as apply to men as women. So in terms of a couple of banks, and maybe I'm looking in the wrong place, or maybe these companies and their SEO specialists are not doing a good enough job of surfacing stuff that is there. And if that's the case, then I'll be the first one to put my hands up and say that I've made a mistake. But I just couldn't see, too many of the retail, the main retail outlets as having that much stuff available. So one or two of the fund platforms have they make an effort and tailor stuff towards women in investing, which is great. And a few of the wealth management firms do as well. But we'll see over time whether this will become more of a thing. But what does drive me nuts, and this put me back in the kind of cynical old journalist bit that I am, just hanging a story on the International Women's Day peg this weekend and then going away and not doing anything else, is pretty cynical, isn't it, really? So more is needed to join up the dots throughout the year, I would say, not just one date in March, which probably gets a bit clouded by the end of tax year kind of stuff that you see anyway. So I was surprised there, but at the same time, I also look at, with my Substack top down, bottom up, I also look at how financial companies are using different social channels nowadays to communicate different messages. And some of the investment firms and some of the wealth management firms are going down these routes, and I'm sure over time this is an ongoing and evolving story. And we'll use the likes of the Facebooks and Instagrams to make this kind of connection with women and investing, and the educational, directing them into the kind of stuff they need to know. And maybe that will be a route that kind of speeds up this process, which I say has been a situation in train for many years.
There's also been a trend in the last probably 7 or 8 years that I've noticed, work in a financial PR space, of journalists at national newspapers moving over to go and work at some of these investment companies, fund platforms, whoever, and writing content for them. We obviously know shares, being owned by AJ Bowen. Kind of everybody knows that's the arrangement. But the way that people are consuming their news and information has fundamentally changed. It's whether it be a different platform, people aren't picking up newspapers in the way they once were. There's a massive distrust for mainstream media, particularly being driven by the right in America. If somebody wants information about markets, personal finance, you've got nearly 40 years experience in this game. Where do you say to someone now are the best places to get their information from, and how do they spot good information and marketing?
Well, I think this evolution and this progression has become very noticeable. It's not a ghastly, sinister thing, and the reasoning behind it is not sinister. It's just the way we're now able to produce content, or the way investment firms are able to produce their own content. I started at a time in 1988 a financial in financial trade press publications at a place called the United Trade Press, which was, I had an electric typewriter, that was my luxury, and a notepaper, a pen and a notepad, and that was it, and a telephone. And I used to get bollocked if I was in the office during daylight hours, because I was told to be out in the city getting stories, getting scoops, and come back and write them up in the evening. So I cut my teeth in a very different time. This is pre-internet. I mean, this was almost pre-desktop publishing. So I've seen the whole kind of arc of publishing, experiences change from desktop publishing to the rise of, Quark Express was a big game changer in the 90s. But this is still pre-internet, and then the internet comes along, and then people have their own websites, and people get their own mobile phones, and people are able to do more data collection type work. As in 40 years I've just contracted that into 3 sentences, but that's how the world has changed. And what never used to be the case was that companies, they never produce their own content, barring maybe a fund fact sheet once every 3 months. Back in the 2000s, when I used to do a lot of work for Citywire, and you try and pin down fund managers about their holdings in their portfolios, you might have a fund fact sheet waved under your nose, which is 3 months out of date, you know. And that was how things were back then. And investment firms and financial services firms generally did not produce content. Now they produce it like Topsy. They produce, you know, evergreen articles. They go down the news and insights kind of route, which we'll come back to in a second. And they're also active on social media. They, you know, produce their own podcasts. They produce, you know, all manner of stuff. And a lot of it is created by journalists. A lot of ex-colleagues, peers, people I've worked for, people who have worked for me, are now in-house in financial services firms, and they do a really good job. But, and I would have to, you know, the big caveat, the big BUT is really this content is a part of the marketing function within those firms. It's not and couldn't really be categorized as independent journalism in the way that I would regard independent journalism. But it's put together by people who were, you know, formerly journalists. And I think the only acid test you can apply in this situation to the stuff that you see on companies' websites, a lot of which is perfectly good, but would XYZ Fund Management, with its news and insights section, ever write something damning about itself? And the chances are it probably wouldn't. And so, you know, that always leaves you with that tiny little bit of, you know, slightly sick-making aftertaste in the back of your throat that, you know, this is marketing stuff, and it's not therefore, you know, created by independent journalists. But that said, there is loads and loads and loads of good stuff on these websites, and it depends on your level as an investor, whether you're an experienced trader or more of a, you know, rookie investor. You know, where do you slot in terms of what do you want to find out more about each day, each week, or whatever? I mean, if you're, you know, on my Substack, I try and look at the industry as a whole using the prism of, you know, a journalist's eyes, and look at what's quite useful and what isn't so useful. And, you know, there are lots of fund management commentaries that are created in-house, maybe with an overlay of in-house of journalism, or maybe, you know, which are perfectly very readable stuff like there's I think Jupiter Fund Managers do a weekly sort of insights thing called Jupiter Merlin Weekly Comments or whatever. It's written by fund managers, but if you like a kind of a, you know, a look at the kind of political scene, the economic scene, how these things mesh, how they might, you know, impact the markets, some of the stuff on there is as good as some of the stuff I read in the, you know, quality financial press. The fund platforms, again, have sucked in a lot of former financial journalism talent, so that there are people who know their onions but now working in-house producing content, doing a very good job. And so, again, the other day I highlighted, you know, for me personally, I think something like the Hargreaves Lansdown website, the news and insights section, does a, you know, if you want to know about what's happening on the markets, individual shares, and with an overlay of personal finance kind of guidance, then, you know, it's perfectly acceptable. And, you know, I'm you know, possibly the wrong person to ask. I've been, as you say, I've done this for 40 years. If you're 21 and, you know, you don't know all the gubbins behind the scenes that goes on into making a story or a feature journalistically, and, you know, you're just kind of happy to absorb the news as it comes your way, then, you know, a viewer or a reader like that will look probably with a less critical eye than I would at some of the content that is produced by these firms. But some of it is very good, and, you know, you know, there's a separate question here for the traditional, you know, financial publishers and traditional media empires as to, well, hang on, we're losing a lot of our staff in this particular part of in terms of the financial world. What do we do about this? Can we compete? Can we keep? It's a tricky one, because the migration of staff has consequences. So the fund platforms, I think, are fascinating kind of creatures, because again, I come from a time as a journalist when they didn't really exist. I mean, I used to run for my sins an investment club. I used to chair an investment club back in the year 1999-2000. An investment club, for your viewers that don't know what an investment club was, it was basically something that individuals could get together, up to 20 people, and invested in shares. There used to be an organization called ProShare, which allowed you to kind of create these clubs, and then you'd meet once a month and you decide to buy a share or a fund or something. And literally you would have the butcher, the baker, the candlestick maker within your little share club. And I used to run one in the Cotswolds called the Volunteer Venturers. And there were 20 of us. And there literally was a stonemason, a bookmaker, a chartered accountant, a chartered surveyor, the mayor of the town where we lived. And we used to meet in the pub on a Wednesday night, have a chat, and say, we want to buy some Tesco shares, or we want to sell some of this or that. What point am I trying to make? But one could bring one's experiences to the fore that one have picked up from my side of the kind of my profession, but people would feed in their kind of ideas, and that we would go about investing. But the point I'm trying to make was, back in those days, if we wanted to buy one share, we used to have a club treasurer account with someone like HSBC, or and then the golden day came when Charles Schwab brought in online trading, and so you could kind of do your trading online. So we're so far, but there were no fund platforms as such in those days. Now the fund platforms are ubiquitous, aren't they? Whether it's Hargreaves Lansdown or AJ Bell or Interactive Investor or numerous other names, they are now in a place in the retail investing space which just didn't exist because of the changes in online. And so it's understandable that they feel that they need to kind of be part of the news news offering as well. They're in a good position to do this sort of stuff. But once upon a time, 30 years ago, it didn't exist. It's nowadays fund platforms are quoted everywhere, and it's understandable because they've got millions of customers. But it didn't exist once upon a time.
And I suppose to defend your cynicism, with obviously these fund platforms with their spokespeople offering their comments, why would it be in their interest? Well, if you're going to sell a share and buy another share because something's happened in the market on that particular day, they take a fee for that. And it's important for people to understand how they make their money. And I suppose you've got regulation which impacts the asset management space and the financial advice space of consumer duty, which obviously is about being more transparent, which I think is also part of this tapestry that we're all talking about of how we get more people invested. But I suppose the last thing that I want to ask you about is, obviously this week we've had US and Israeli forces decide to bomb Iran, which has then had counterstrikes in other parts of the Middle East. There is then a lot of news in the personal finance space about how it's going to impact people's finances back home. Can you give me a little bit of an oversight into how a war that the UK is not really involved in is going to have an impact on the markets here and globally and our wallets?
Yeah, and I think the first thing to say, and this, it sounds a bit trite, but I think it's worth saying, the war stuff for people on the ground is a pretty rubbishy thing to be involved in. And so we have to think of them, and there's human stories or human misery stories, probably going to be a lot more of them coming out of the kind of news in the next few weeks or months. But the market's a cold-blooded place, and we have to look at, from a financial perspective, how these big geopolitical shocks kind of affect, our capacity to make money, the pound in our pocket, and all the rest of it. And we're only in the first week in March, Kez, and I'll take you back to the start of the year, and we had Venezuela, shock, Maduro hoiked out of the country. Then we have Greenland, shock, Trump wants to go and and now we've got Iran. And in fact, Iran was in between Venezuela and Greenland, and it went quiet. Then it's all taken off this week. And I think from the cold-blooded kind of markets perspective, the story is obviously the energy price spikes that we're starting to see. And I think the story will basically boil down to, sort of offering the conclusion first, is just how much will US military might bring this to a conclusion. And I think the markets are thinking, and markets have behaved in a pretty sanguine fashion this week. I know the oil price is going up, but at the moment, and the one or two exceptions, South Korea's Kospi index took a walloping earlier this week because they're big net importers of fuel. But if US military might kind of puts a cap on this thing, then the thinking is, well, the energy price spikes that we're seeing won't become super inflationary. And all will be well. But I have to say I'm a little bit more cautious and a little bit more pessimistic about that scenario. The problem with the energy issue is problems with the oil prices kind of impact the economic system very quickly. We see it straight away at the petrol pumps, but then there are other issues to kind of factor in as well. So you get a problem with energy issues. Petrol pumps can in fact impact utility bills. Our utility bills can take a hammering despite the presence of a price cap. So that might happen a bit further down the line because we're insulated at the moment, April to June. And then there's another knock-on effect because energy moves into, well, we need fertilizers to grow our food, and we end up with a food inflationary problem. And none of this is good for the pound in our pocket. And if the inflation continues, then where we've once been in a position at the early start of this year when we thought that interest rates would be on a downward trend, there's an interest rate decision next week, which everyone was either thinking would probably result in another quarter point cut off the 3.755% that the base rate's currently at. But that now looks like that's less likely to happen. And if interest rates hold or don't continue to go down, then that has a problem for mortgage holders, and so these geopolitical stories, which seem a long way away, kind of come back to haunt UK households and individuals. And if should the inflationary story continue, and this isn't a US military might doesn't put an end to this situation, and Middle Eastern stories like this can have a habit of getting messy, then if interest rates end up having to rise, that will be bad for markets further down the line. So that's a potential problem for investors to watch out for. So it's all very messy, and as I say, I think markets have been reasonably sanguine that there would be some kind of end to this. And actually, over the course of time, these kind of geopolitical spikes do have a habit of they disappear into the rising equities story over the course of years and decades. But it's probably going to get messier and will leave investors scratching their heads a bit more for the short term than anyone could have even perceived as happening at the start of this year. The UK market was doing pretty well at the end of last year, and things seemed to be set for a kind of benign period. But then, Donald Trump comes along and pulls these kind of rabbits out of hats, for want of a better phrase. So in terms of what but then, at the same time, volatility is part and parcel of the stock market. You have to, as an investor, you have to be to accept that that's the case, and you have to kind of prepare for these things by, it's good financial planning practice, really, or good investment advice practice to, if you've got a diversified portfolio of stocks, that is one way to mitigate against, volatility or nasty shocks to the system. There are ways and means to kind of keep a lid on this. Just running for the hills and taking your money out of the markets generally doesn't tend to end well for the investors that do that. They often end up, if there's a rebound, they're then out of the market, they have to come back in. They don't necessarily, benefit from doing that, although human nature might say, right, let's get all our money into cash. But then that brings its own problems, trading, costs of trading, and then you're in cash, which may not be the best performing asset class for you. Especially also if you're a long-term investor. This is the other thing, and we go back to the start of our conversation about this notion of why do we invest? Because we try and get a bit more, money. We try and make a bit more money from different sorts of assets than just sitting in cash in the bank, which can be eroded by inflation. That's why we invest. And why do we have invest in a diversified way? Because of issues that are arising this week. It's sensible, but we invest because the data tells us, going back over 100 years, that markets are still a pretty good place to be for your cash over the long term. We're looking at maybe 8, 9, 10% returns annualized. The data tells us for the last 100 years. Bonds maybe give us 4, 5, 6%, cash 1, 2, 3%. So, if we want to grow our long-term wealth, we have to kind of, just face up to the facts that there will be these jolts along the way, but they're not to be too knee-jerk in our reactions to them. The markets have a kind of a habit of sorting themselves out over the long term. And investing isn't gambling, and but I do know some very shrewd gamblers, but in investing it's maybe that's the kind of the message that needs to kind of, whether it's the squirrel in his bathers or whoever it's going to be, this idea of putting money into the markets and just sitting there and let it do what it needs to do and let companies become successful. And, maybe that's the kind of issue that needs to be capitalized on and focused on going forward, than the other kind of messages that we've kind of seen come and go in the last 20, 30 years.
I think there's two clear things that people need to focus on, which is what their goals are and what their risk tolerance is. And I think we saw this in 2020 with the invasion of Ukraine. If you were happy to be a slightly more tolerant of risk and put more money into, say, defense stocks, there were opportunities in different sectors. Again, post COVID, people were taking money out of property, because obviously particularly commercial property wasn't performing. And I think with all this thing there, with all of these big geopolitical kind of impact conflicts, whether it be a natural disaster or a war or whatever it is, there are going to be some opportunities in there. Do you think, because obviously we still have the Ukraine-Russia conflict going on in the background, that many of the newspapers appear to have forgotten about, that is still happening, and now we've got this other conflict, which now means you've got pressures on oil and gas. Do you think there are opportunities, if you're just a retail investor who maybe is fairly young, got a little bit of disposable money, they're happy to put in the market and be a bit riskier with, not saying gambling as you said, but happy to look at some opportunities outside of an all-world index fund or an S&P 500 fund? Are there any sectors that you see there might be opportunities during this period of geopolitical instability?
The kind of classic answers to this are, in this situation, defensive stocks, and what are deemed defensive stocks are kind of your go-to kind of investments. So what do I mean by that? It's the stuff that we can't do without, even though we're even if times get a bit sort of squeaky bum. So consumer cyclical, defensive consumer stocks that, food producers, the Unilevers, the Reckitt's, and people like that. Infrastructure. Quite often, infrastructure type investments are pegged to the contracts are based with in terms of, and they're contractually obliged and have some kind of inflation linking into them. So if inflation, so the inflation story is mitigated by dint of the thing you're investing in. Property is sometimes thought of as a defensive kind of play, and what we're trying to get away from are the cyclical stocks that kind of come and go, which are subject to the whims of fashion and consumer demand or something like that. But there are a lot of kind of old chestnuts in the investing chestnuts in the industry, and time in the market rather than timing the market. There is a reason why that has stood the test of time, and not getting too frit about individual kind of incidents, and just once your money is committed, and certainly if you're at the beginning of your investing path, when you've got maybe 20, 30, 40 years for these things to unwind. It's a different story if you're about to retire and you've got an equities only portfolio. That's a different type of lifestyling issue, which we probably won't talk about now. But if you're talking about investing at the beginning of your life or your career, and putting a little bit of money aside, then you can afford to be a bit more risk averse, a bit risk tolerant. You might think, that and again, it is a personal thing, and this is why we go back to why there's a quarter of a trillion pounds in stocks and shares, maybe ISAs, and $750 billion in cash. So we're still and there might be all sorts of reasons why people keep some of their money in cash, but the chances are some of that extra $750 billion could be diverted towards the stock market. But it's up to the industry, it's up to policymakers, it's up to, if it's such a good thing to happen, then why isn't this message beaten that much more loudly and that much more clearly? Generally, I think there's still this very big disjoint between the stock market and what people perceive as happen in the city, and their own finances, and how by investing in the stock market they can grow their wealth. So I don't think we've been very good as an industry, kind of melding this creating a better image. But I still think we're a bit kind of, like The Apprentice was on the telly last night, right? So that's kind of, and Dragon's Den, and we kind of got these siloed views of what finance is like. But at the same time, can I just, I don't know how much time we've got left, but I was thinking about this the other day. If we were say you and I, and say 4 of us were in the pub, and say I had put 20 quid on say I was paying for my round in cash, right? And maybe I got a couple of 20s out, because of course, a round of drinks now is blinking expensive. But say I had 20 quid on the table, and someone walked past that table, right, and picked up my £20 note. My first reaction to them is, "Oi, what are you doing with my £20 note?" And in a funny kind of way, what we don't do when we hand money over to the financial services industry or the investment industry, we don't do enough saying, "Oi, what are you doing with my money?" Because this is the thing that I've always tried to impart on the journalists that I've worked with. The whole reason the City of London exists, the whole reason insurance companies exist, fund managers exist, wealth managers, it's our money, right? It's not theirs. They might live in very, ivory towers, fantastic, luxurious, working luxurious places, but it's our money, and we should ask, and maybe, it doesn't really behove the industry to let, us, the hoi polloi, ask a bit more about what's happening to our money. And maybe some people aren't interested. But if you're interested about why some geezer picks up your £20 note in the pub before putting it back down, then I would suggest to you it's worth, having an interest in where your investments are going. Asking for better explanations about why you've chosen this route. Because one thing down the years, I have been sold some right old guff stories by fund managers down the years, and some fund managers have been absolutely brilliant. But they're not all brilliant. So it behoves us to keep a beady eye on what companies do. It's our money, and again, that's quite combative. But it's our money, and we kind of defend other instances of our life, the parking space at the station, within an inch of our life, right? But we don't, once we hand the money over to the ivory towers of the city, we don't always think about what's happening with that money. And I think maybe there's kind of an interest, get more interested in where your money's going theme to come out, because that's the only way we can really connect. We're when you're buying into a fund, you're supporting UK industry or overseas. You're supporting companies. There's more of that needs to be surfaced. I'm giving these content guys, I'm telling them what they should be doing now. These content guys in investment firms, maybe they need to surface this even more, because there's quite a lot of backslapping in the city and jargon, and feeling quite entitled, that doesn't then seep out into the place it needs to seep out. That's what I would say in having looked at this over. The number of times I've sat in fund manager presentations when after I give a fund manager £1,000, and at the end of the year he says, well, I've turned it into 870, but because my peers have turned it, into 820, I've done really well. You think, no, you haven't. You've lost me 130 quid, is what's happened. And these are quite, they're quite crude, vulgar, basic kind of assertions, but they need to be answered. And I say maybe that kind of, extracting more of the reality from the city sometimes is not a bad thing.
A conversation I always have with my dad is how I don't believe people understand how much of a voice they have when they vote with their wallet, and whether that be where your pension's invested, because obviously my generation has a workplace pension now, so there could be several £1,000s in a default fund doing very little. You might be particularly conscious about the environment. You want it to be in a pro ESG fund, and there are lots of decisions you can make by pulling that money out of, say, BP and put it into somewhere else, sends a message back to the market. But I'll ask you one final thing. I want your 1 minute pitch about your Substack and what you're working on at the minute.
I pick the week's investment views, comment and stories that I think are really worth looking at. I delve into quirkier corners of the industry. I do exclusive research and interviews. I scour the internet and beyond for the most interesting content produced by investment firms, wealth managers and financial advisors. I think communication is so important. And having been in the communications business myself for 40 years, I'm always intrigued as to how people go about doing it, and who are examples of best practice.
And any particular stories we should keep our eyes out for, whether from yourself or from anyone in the industry?
I think there's a UK retail investing campaign issue coming up in the spring. There's already been a bit of toing and froing. There was a story in the FT. I think it's Saatchi's are doing the campaign. It now seems that it's not maybe going to kick off with quite the bells and whistles that the 19 signatories to this campaign thought was going to happen in the April time. It's more of maybe a kind of a steady, reveal of stuff throughout the course of the year. That, for me, I'm going to keep my beady eye on that, because it's these sorts of these stories are what are going to get people investing or not, frankly. And the chancellor's obviously very keen to get people more investing, although some of the announcements made in last year's budget might appear to the contrary in terms of racking up the the tax rates on dividend tax and things. But no, I think the investing campaign and the idea of targeted support, so what companies will be doing to nudge their customers with a little bit more advice, the continual migration of my former peers from a lot of journalism into working in content jobs, I'll be looking at keeping abreast of. If a horse called Haiti Couleurs wins the Cheltenham Gold Cup next week, I won't really care much about anything, having backed it down at all rates since last autumn.